Welcome to the second edition of our new podcast series, Talking Data, which offers timely insights into macro data and its impact on the economy and markets. I'm Kristen Radish of ArborResearch&Trading. Our podcast features Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. In today's installment, Jim and Ben will be discussing market prices versus economic growth and fundamentals amidst heavy monetary and fiscal policy intervention. So I'm going to get us started off today here with taking the first question over to Jim. Are U.S. equities in line with economic growth and fundamentals? Your thoughts, please.
Yeah, I don't think that they are. I think that the market has run ahead of the fundamentals. The economy is recovering from the pandemic, but the recovery has been slowing, and it's not been reversing, but it's been slowing. But the stock market is completely recovered. If you look at valuation measures in the market, even if you back out the work from home or the FANG stocks, you still get some forward-looking measures like the 12-month forward PE ratio on value stocks or mid-cap or small-cap stocks at the highest we've ever seen, and that the market is ahead of the fundamentals. Why? The distortions from the government, the Fed's money printing, the promises of bailouts from everything from cruise ships to airlines, and a lot of the stimulus that we've seen, either the $1,200 checks or the extra $600 a week that we gave the unemployed.
Okay, so over to me. Yeah, so I take the opposite view. So I think that the financial markets and the S&P 500 in particular, though seeing this heavy dispersion between staying in, going out, up 30, 40, 50% in certain cases versus the that's the staying in tech crowd, the going out crowd still down 10, 20, 30% in certain cases, but overall the market's looking really good. And what I can look back to is real-time measures. I don't care if it's some of the Fed's new weekly economic indicators. It could be home-based hours worked, or it could be my favorite search activity on a series of consumer items and services. Those all bottomed the week of March 22nd, which is exactly when the market ended up bottoming. I think the problem is the market is too attached to how well the economy is doing and is so attached to a very short-term view. The Fed has gotten very short-term themselves, but as economic data has rebounded and these short-term measures, for example, home improvements have been running about 2 to 3 standard deviations above normal. We've seen same-store sales, around 35+% for a lot of these big retailers. Digital is doing 150%, and we've seen this transformation of how the consumer spends. And that's been good, and that's been evidenced in these stocks that are taking up most of the market concentration. And I think the market is so correlated to those short-term movements that will dictate what happens going forward.
So Ben, let me ask you then, your argument about that the market is very tied to the economy. Congress has not passed a second stimulus package. There is no additional $600 a week. There is no additional stimulus check. There is no bailout for the municipalities or even the post office. The Democrats passed it, but it's not going anywhere. Does that mean that the economy should start to reverse a little bit if this maintains and we don't see a stimulus package going over the next few months until the election?
Well, that's what I thought too initially, but then you have to realize we had near 33% savings rates. It's dropped down to 19%. If you look at the surveys based on how people spent the actual stimulus checks and the FPUC payments, roughly about 40% of that got spent. So we have this heavy amount of savings, and what that really leaves is almost $1 trillion over the next year that could be spent. That's really just held in savings. That's almost $78 billion per month. So if you look at the short-term indicators after the end, July 26th through now, we've got exactly a full month of activity to look at. That activity has not demonstrably slowed. So the consumer is still spending and they're doing it somehow. That doesn't really mean that there aren't plenty of people in the leisure industry and those that are still outside the workforce that are really struggling. Those are who we need to help. But bigger picture, as a consumer as a whole, there's a lot of still dry powder. There's money there to be spent and is being spent.
So let me run another argument by you, because we disagree on this, and this is interesting. If you look at the valuation measures in the stock market, let me put them into two broad buckets. There's the backward-looking valuation measures, trailing PE, to stocks. Those are useless in this environment because we know that they're all high because we've wiped out earnings over the previous year. So the next question is where are they going to go over the next year or two or three? So if you look at those measures, even if you look at value stocks, which doesn't include the FANGs, if you look at mid-cap stocks or small-cap stocks, the S&P 600 small-cap index has a forward PE ratio of over 40, which is the highest it's ever been, way higher than it was in 2000. So these non-disruptor kind of basic stocks, the question is, why do we see these massive valuations on the market, maybe way overvalued? The bull story would be, well, Wall Street, because remember, these are forecasts from Wall Street, median estimate of all these companies over the next year, two or three, are grossly underestimating the recovery. But most of Wall Street thinks we're going to get a vaccine, thinks that we're going to get back to work within the next year, and thinks everything's going to cover. And history says that typically the 2 or 3 year out forward earnings are usually not underestimated, they're usually overestimated. So when I look at those numbers, I say, boy, this is like the most overvalued market away from the FANG stocks that we've seen. And it gives me pause to think something else is pushing this market, maybe Fed liquidity. Why don't you think that that's, or do you think that's a concern, or if not, why not?
No, yeah, I mean, I can understand valuations, specifically also with low interest rates, could be, are, high on a relative basis. And maybe some of that is due to the low interest rates, some of the Fed inertia. What I would say is that, and we can get into this here in additional questions, is I think there can be a multiple put on the actual degree of rally, meaning that I think the direction of the equity market has been perfectly timed by the short-term measures of the consumer. Maybe we have become overvalued, and maybe even on a historical standard, because of Federal Reserve, both fiscal and monetary policy support that offers a multiplier on top of the good data. And that's something, again, we can get into a little bit deeper. That I think is harder to define. I think there's some of that present. How much of it, I really don't know. We won't know until we get this, I think, a knockback in the short-term spending, items and services, everything from apparel out to urban transportation. Once we see a setback, we may start to understand how markets react relative to that news and these valuations you're talking about on a longer-term horizon.
I'll agree with you there. I do think that the rally in the market has been perfectly timed with the economy, and that makes sense, and I understand why. And again, the economy has recovered from its first quarter or March or April low. It's just, I guess, an order of magnitude. Has the market leaped ahead of where the economy is going? And that would be my bet, is that it has leaped ahead from where it's going right now, and it's gotten into that overvalued rate as well too, and that's got me a little bit worried. I think what's been pushing the market has been the idea that the Federal Reserve has been so aggressive in purchasing of securities. Now, they're not purchasing equities, and I know that there's tinfoil hats out there that say they're purchasing equities, but they don't need to. They're purchasing corporate bonds. They're purchasing fallen angels, junk bonds that used to be investment grade prior to, that lost it over March 22nd. They're purchasing corporate bond ETFs. They're purchasing municipal securities. They're purchasing PPP loans. They've got all that set up. And the argument is, look, if they're purchasing ETFs and they're purchasing LQD, which is the investment grade ETF, and HYG, which is the high yield ETF, and they've got that facility in place, it'll take them 5 minutes to tell BlackRock, their executor, to say, okay, you can buy SPY now too. So they've got everything all lined up if they need to buy equities. And that has been a big support for the market. I'll remind you famously that when Mario Draghi said in 2012 that he would do whatever it takes because you had that massive spread widening and rise in sovereign yields in Europe, he wound up having to do nothing after that because it was just the promise that he would do it was good enough. And I think that really what we've got here in the stock market is we've set up all of these corporate bond programs, and by implication, there's a promise that if the stock market got a little bit wobbly, which it has not since March, that they would step in. What's your thoughts about that?
Yeah, so there's no doubt the biggest impact that we've seen is in the credit market. So if we run models based on history and economic data, credit environment, bid-ask spreads, general liquidity, there's no doubt that the credit markets, both investment grade, from AAA all the way out to, the junkiest of junk, would have been much wider than they were. The big issue now, though, is what truly are default rates, and what are those default rates that credit investors and overall investors are pricing in. And those have proven so far to be right, that they're lower than expected. Now, we do have a rash of bankruptcies. We've seen it with Valeris, CBL, and others, but I think we have somewhere around 130 to 150 bankruptcies in the U.S. that are larger companies, larger in liabilities, that can attribute it to COVID-19 as the reason that they're essentially going belly up. But this hasn't really, the pace is high, but we haven't reached the magnitude that we saw during the financial crisis. And that's kind of the big question here. We've seen this rash of bankruptcies. Maybe it's somewhat slowed. Is this something that peaks now, between now and October, or not? And I think ultimately, that will have implications both for the equity and the credit market. But I do agree, there's no doubt the ability for the Fed to squash volatility, which has been tremendous in both treasuries and credit, has had a very positive impact on equities. The only big thing, and we can talk about this in the next topic, is that now those two risks are the least aligned that they've been in years, just in the past couple of months. And we'll talk about that.
Yeah, last word on this topic real quick. One thing that I would also argue, silence is deafening, is what you don't hear from the Federal Reserve. While whether you agree or disagree that the stock market is being influenced heavily or distorted by Fed liquidity, it is a major story. And the Fed kind of goes out of its way to not address it. They would rather talk about inequality. They would rather talk about unemployment. They would rather talk about inflation. But when you get to the question of, is the stock market overvalued and are you the cause of it, Federal Reserve, Jay Powell kind of looks at, who, me? What are you talking about? Any other questions? He just doesn't want to touch that subject. Doesn't mean that's a telling sign that they're worried. I think it is a telling sign that it is an uncomfortable subject for them, but they have gone out of their way to really not answer that question. And I do think that that's a bit telling. How about the next topic, Kirsten?
So if we go into equities versus US Treasury yields, who's right? And is that really the right question?
I'll start there. I don't think it's the right question, because I think that they're really trying to discount two different things at the same time. When we talk about Treasury yields, the big fundamental, the big overarching fundamental with Treasury yields is inflation. And DGT, which is demographics, globalization, and technology, Ben, you coined the acronym, at least to me, is the overriding thing that is keeping inflation down, at least through now, which is keeping the overall level of interest rates down for starters as well too. Add to that, in the previous section, we talked about equities. Well, in treasuries, they are buying treasuries. They have bought $3 trillion worth of treasuries since March, $260 billion worth of tips since March. There's a direct influence there. Equities, on the other hand, are supposed to be a forward-looking mechanism. So I don't think that that's the right question, which one is right. But what I would argue, which is related to that, is that I believe the 60-40 portfolio, which is the bedrock of what wealth managers drive their customers into, this idea that you own 60% equities and it goes up, but when equities wobble, then interest rates will go up and offset that. I don't think that's going to work at these low levels. You are subject to, it doesn't mean it's going to happen, a nasty 15-20% decline in equities, but I don't necessarily think you're going to get a 200 basis point drop in interest rates from these levels to go to -1.5 to offset those losses like you would have when interest rates were at 3%. Ben,
yeah, and that gets right into, so here first, what you just last spoke about, how governments and treasuries as a component of that 40% of the safety portfolio, and that there is no doubt that investors really since the early portion of June have not necessarily abandoned the 60-40, but how flows are coming into ETFs, for example, has dramatically changed. So governments, in terms of all governments, US Treasuries, boons, and so on, those ETFs have seen nothing but balance to outflows since middle of June. And so where has all that money gone? Well, it's chased the Fed with, in terms of liquidity and their support of credit markets, LQD, HYG, and so on. That dominates, 40 plus, 50% plus of every dollar that comes into ETFs. The other place that money started to go, and we've seen that, is gold and even things like Bitcoin. And I think a lot of that has to do with the idea that we're at this, lower bound in interest rates, where there's the chance of inflation. Who knows? Individuals are looking for alternatives. I'm not going to go out there and say 60-40 is necessarily dead, like you, Jim, but I do think that the search for alternatives has definitely begun with COVID-19 and the tremendous drop in rates, and then the Fed fueling credit markets. Now, is this the right question? Equities versus treasuries? Totally agree. Different fundamentals, different focus. Treasuries also are chasing the central bank itself. So we've just seen indications that rates are going to stay low where they are for the next 4 or 5 years. And given average inflation targeting likely announced by Powell, the shift here isn't so much that, we were going to get inflation back to where it needs to be. The shift is we might not now raise interest rates the same degree we would have to chase the so-called natural rate. So if natural rates are stable to higher, whereas in the past we would chase them like they tried to preemptively do all the way through 2018, which ended up being somewhat of a mistake and going too far, they're not going to repeat that same mistake. So I think that the crimping in volatility across the entire treasury curve, you look all the way at the short end, for example, the swaption vol, that is essentially dead. The long end can't even really get much of recovery. So I think that that game has been so controlled by the central bank itself and the lack of inflation, like you said. We start to get that right side tail on inflation, like we discussed in our last podcast. Things get really interesting very quickly. The odds of that happening in the near term are very low, given the heavy shock we've seen. And the Federal Reserve themselves said they're more concerned about deflation, disinflation, which I think rightly so, than they are about seeing inflation poke to 2.5%.
I want to go off on a quick tangent and underscore a couple of things that you've said. The flows into fixed income, especially corporate high yield ETFs, as a percentage of all of the flows, has been the highest we've ever seen in corporate and high yield as a percentage of everything. It seems like everybody's taking to heart this idea, co-invest with the Fed. The Fed is buying this stuff, so go run into and buy that stuff because you've got the Fed playing in that space. So you want to go along for the ride. And that's where at least the institutional crowd has run. I'll push back a little bit on the idea that this is the most hated bull market ever. This is a common phrase you hear from everybody because they look at the flows and they say, look, they're not buying in the mutual funds, they're not buying in the equity ETFs to the degree. And I like to, carefully say, no, they don't hate the stock market. They hate you, Mr. Active Manager. They would prefer to put their money into something directly. So this has fueled this big discussion about the Robinhood trader and the rise of the retail trader. That's where the flows into equities are going. They would rather buy stocks directly because you can buy fractional shares, you can buy them on zero commission, as opposed to buying a structure, whether it's an active manager mutual fund right now or an ET or a low fee ETFs. So there is that flow that's definitely going there. On the inflation part, I don't want to rehash last conference call or last podcast, excuse me, but I agree that if we see that right tail and that inflation moves up, and I agree that is not a story for 20 or maybe the first half of 21, because the shock of the economy is still got us excess capacity that's going to take time. But let me throw out a hypothetical for you. What if we do get that vaccine? And what if we do get a therapeutic? And what if we do say that by spring, hey, COVID's gone. We could start returning back to work. We could start going back to the office or some version of that. We could go out to dinner. We could go out to the baseball game. We can go out and sit in arenas to watch concerts. All the stimulus that we've pumped into the economy, and we come back. I think the second half of 21 into 22 you can see that right tail of inflation as well. Even without that vaccine, there'll be some kind of return to normalcy as well too, that we'll see from that point. What's your thoughts on that, Ben?
Yeah, I mean, inflation, I try to keep more of a short-term to medium-term view and really track what are investors doing, what is the consumer doing. We've been calling for this head fake since maybe April in CPI. We've gotten a little bit of that, specifically on the flexible side of CPI. I think that comes back down to normal. Even if we do get a vaccine, we return back to normal life. Even with the balance sheet, growing to the size it has in the central bank side of the equation, I don't think that game historically has not shown any evidence of producing lasting long run inflation. I think there's no doubt there could be another head fake maybe on the horizon. The fiscal side, I think we've only just begun to really figure out and understand with these FUC payments, stimulus payments, and really getting more direct support to individuals. But with the reluctance of the Republican side of the equation to actually continue stimulus checks and continue a lot of these unemployment benefits, I'm kind of concerned that scenario is not really going to rear its head. So it's not that I'm bearish on inflation. It's just that markets have come back to somewhat normal condition. Expecting 1.5% CPI, but I don't know the 21-22 story dynamic. I think we'd have to see a lot more fiscal policy than we are now, and I don't care really how big the central bank balance sheet gets. I don't think it translates. It's just a maturity transformation, not necessarily something that's going to induce inflation.
Yeah, I'll just say the last thing about inflation, and then maybe we can move on to the next subject, is we're talking on Wednesday the 26th. The next tomorrow, Jay Powell is going to give his Jackson Hole conference. He's supposed to lay out average inflation targeting. And I'll remind everybody that when it comes to inflation, I think it's as much up to the markets as it is up to the Fed. So Powell will lay out this theory and lay out the groundwork for how the Fed's going to maintain policy. I'll remind you, at December 2018, we're going to reduce the balance sheet. We're going to reduce the balance sheet by $60 billion a month. It's going to be like watching paint dry. It's going to be no big deal. Dow fell 600 points, or 3%, during his press conference that he was laying it out, got crushed for the next several days. And 2 weeks later, Powell spoke and said, all that stuff I said in December, forget it. We're going to be patient, we're going to be flexible, and we're going to go on to this new regime. So he'll lay out this plan for inflation. It only works as long as you don't have it. But the minute you get inflation defined as enough to get interest rates to start going up meaningfully, then he could throw this out the window and we could see them start raising rates a lot sooner than we think. That's if you get it. Kirsten, how about the next subject? Moving on.
Sounds good. Is the Federal Reserve fueling higher asset prices? Is there a bubble in equities and credit?
Yeah, so it seems like we kind of already discussed this one for the most part, so it might end up being more of a rehash. But again, I think this gets down to, for me, is again, there's direction and then there's actual magnitude. And this is what I was talking about. We build models using the DGT, demographics, globalization, technology, and general econ data, and you can use those to explain both interest rates and also, for example, S&P 500 monthly returns, and explain about 60 to 70% of the variation in their returns out of sample. So you're using a model pre-2010 and you're applying it 2010 forward, and you can get close enough, specifically in interest rates, to show that really not including the Federal Reserve, you're able to, again, explain this direction of actual asset prices. Now, the problem is some of the magnitudes get wonky, and that's where this multiplier effect comes into play. And I think that some of the backstop the Fed provides with the larger balance sheet, not necessarily the balance sheet size itself, but the flow side as opposed to the stock, has had an impact in increasing the size of the equity market in terms of its return. And so I know that by looking at how I include the Federal Reserve's balance sheet within a model, for example, it only seems to boost performance when it's used as an interaction term, meaning that it's multiplied against another variable like GDP or consumer spending and so on. and that's the only place I find it's being beneficial. So now in terms of creating a bubble, seems like Jim, I'll let you take it away here in a second. Maybe there are some concerns about overvaluations. The credit space is so difficult to determine given the heavy meddling by the central banks themselves. But again, I still turn to default rates and the markets and investors, these credit investors. These guys are smart guys with all of these models. Jim has some in his family. They're still maintaining pretty tight CDS industry by industry, and also low default rates. And so I think they're kind of seeing maybe the sunshine here on the back end of this. And so I think things are a little bit better, and the Fed has gotten us through this period of turmoil like they should. And now it's just a question of if that's true or not, and that's something we'll know potentially by October, November of this year.
Yeah, just to keep family unity, high yield investors are some of the smartest people that you will ever meet in your life, because I don't want my wife mad at me. So, but I agree with you that in one respect, there could be. Are we in a bubble? I'm going to default back to the old Greenspan argument of a bubble because I believe it. You only know it after the fact. It's really hard to know it, contemporaneously if you're in a bubble. But a couple of thoughts for you. Let me start with the credit aspect of it. I understand why the default rates are down, and I understand why the CDSs are so tight. And that's largely because corporate issuance has already exceeded all of last year. So if I'm a shaky company like Six Flags or Carnival Cruise or Norwegian Cruise, you can look at my business model and go, oh man, this business model is the worst for COVID. And when Norwegian tried to restart some of their cruises a couple of months ago, they got out to sea and everybody got sick and they had to go back and cancel the cruise. You go, this business model's in trouble. But because the market was opened up by the Fed, they were able to borrow enough money. Six Flags does not need to have a single person in a single park until next summer, and they're still around. They've got enough liquidity on hand to go another year before they need to get their parks open. The market allowed them that to issue debt to get over that chasm, if you will. So I understand why we've got all of that in terms of the low default rates, because they've just got enough not to default. Now, whether or not that turns out to be the right strategy longer term, because if we return to normal, are they still going to be able to pay off that debt? They've got a big high debt load as well. We'll have to see. In terms of equities, the push-pull here is the standard metrics in equities that you look at, of earnings or price to book, and I'm talking about forward measures here, not backward measures. EBITDA, cash flow, market cap to GDP, take your pick, says that the market is very high relative to history. Maybe only the 2000 bubble was higher. But the big argument is there another fundamental in there that we must factor in? Federal Reserve policy, promises of bailouts, promises of stimulus. Is that an exogenous event in markets that is coming in and distorting it, or is it more along the lines that some people say, no, it's not a distorting effect, it's now part of the permanent background?
Well, that brings up a good question. Let me ask you a question then, Jim. So we've just, today articles abound about the whole next 4 to 5 years of ultra low interest rates that the Fed will carry forward. So does that mean that really we could see 4 to 5 years of market distortions? I think the markets, equity markets in particular, will continue to ride on that enthusiasm. And does that to you mean it's distortion because they're artificially keeping rates low, allowing valuations to be high? The R within all of these equations, is boosting the ultimate end of the equation. I mean, what are your thoughts on that?
As far as the Fed goes, DGT, demographics, globalization, and technology, I do think that interest rates are relatively close to where they should be, given the lack of inflation, and the Fed got rates at 0. So I'm not going to push back too much that they got the wrong level on rates. Credit spreads and some other things I could push back on a little bit more as well too, because that's where they've been doing a lot of their buying. My concern is that in the future, a year, like I said, second half of 21, 22, you're going to get higher inflation, and that's going to push rates up. they'll try yield curve control. They'll try to hold those rates down, but the market could overwhelm them. Where I do think you have distortions, and we are in a globalized world, is I think you've got them in Europe and Japan. I believe negative interest rates are wholly unnatural and that they are not something that would ever occur naturally given the structure of our financial markets. So when you get the ECB pushing their policy rate down to minus 50 basis points, or you get the BOJ pushing the policy rate down to negative rates, that is a wholly unnatural event that is happening in those countries, pushing their rates down that far. Because I don't think our financial system is structured for negative interest rates. It hurts a lot of the areas of the financial system. That's where it is. But keep in mind, we are a global economy, and it's really hard to separate these. You know, my favorite example is IBM has IBM Europe. It's got 15,000 employees in Europe. You know, whether or not the interest rates in the US are relatively normal, that might be one thing, but they can borrow in euros and, you know, with a base rate starting at minus 50 basis points. And since they're an investment grade yield, they could borrow, if not negative rates, and there have been some negative corporate deals done in Europe, they can borrow it very close to zero. That's where you get that distortion. So I do believe that they're distorted in Europe and Japan, maybe not as much in the US because we haven't gone negative, and that's why I've been against it. But I think if we get inflation, all bets are off as far as where things are going from there. What's your final thought, Ben? And then we'll move on to the final subject.
No, I think we're actually kind of covering the final subject here. I mean, the distortion argument again is a tough one. It's one thing to say the Federal Reserve, you know, obviously has pumped and helped volatility come down so heavily in the credit markets. Would we ultimately have gotten to this point? I don't know. You know, if, for example, the counterfactual of COVID-19 never really happened, or if we could erase the damage that was done really in March and April. You know, I think if there's anywhere to point at it, and it seems like you're alluding to that too, it would be in that space with, you know, IG and high yield OAS. The equity market's a difficult one. I think the consumer is still spending, and the way that the economy is now functioning and how it's concentrating on these big name, big tech, you know, highly productive companies that are able to keep cost of goods sold down so much relative to their smaller competitors. I mean, we're talking about, you know, differences of, you know, cost of goods sold for small companies have risen 150% since the financial crisis. You know, for these highly productive companies, they've only risen 50%. And so I think that has been a boon for those spaces, and that's why they're capturing so much market power. And I think that the equity market is reflecting that. So I don't know so much that you can raise a major red flag that the equity market is highly distorted. Maybe in historic valuation terms, I get that. But again, we're still staying in tune with what the equity market should do, which is what's happening with the consumer and its expectations and businesses and what that means for earnings going forward. And that future is fortunately getting brighter and brighter by the day here moving forward. So I'd say a no with the distortion side for the majority of the equity market, and really for interest rates. I agree. Interest rates, you can model this out. We do all the time. They're pretty much where they would be without the Federal Reserve and without COVID-19. This is just the inertia of the push and drop in interest rates due to what Jim alluded to. DGT is so strong that I'm not surprised. I don't think interest rates are manipulated by the Federal Reserve in any way. They can control them all they want, and we'll maybe figure out how that happens here going forward. But they've been chasing a natural rate that just keeps falling.
You know, there's one other aspect of the distortion argument too. We look at markets and we analyze markets, we being all of Wall Street, you know, and derivatives of that, because we believe that what they are is they are the intersection of buyers and sellers making free decisions and judgments. And we look at markets to see what kind of judgments and decisions they're making. Well, if the largest player in the market is a price insensitive buyer in the government, promising a bailout, or the central bank printing up money to play in the market, one questions whether or not those markets are still giving you signals. You know, the British economist Charles Goodhart had his Goodhart law, which says that when a measure, say interest rates, becomes a target, yield curve control, it ceases being a measure. So that when you get yield curve control, which they have in Japan, which we've been openly talking about in the US, as far as becoming then looking at interest rates to say, what are they telling us about the economy or inflation? They cease to tell us that because they've become a target and the price insensitive buyers in there. We know the price insensitive buyer is playing in a big way in the bond market. I agree that we haven't pushed interest rates out to the nth degree where we go, like I believe they have been in Europe and in Japan, where we say, boy, these things are just completely out of whack. But that could be the story as we move forward from here if we see that rise of inflation. Ben, I think we've gone about our prescribed amount of time before we bring Kristen in to finish it up. Final thought for anybody out there?
No, I think that talking about what you just said, the last thing I'll say is that the VIX and the move, for example, with this difference between the Treasury market and the equity market is so visible now in terms of their relationship. So that correlation has dropped to zero. So for investors to know, should I be concerned about the bond market, which it hasn't been moving at all, but if it starts to move, should I be concerned? I think you'll know it when that VIX and move correlation starts to come back into play and that relationship reestablishes itself. Then we have markets maybe functioning more like we're used to, pre-COVID-19 and pre the heavy, monetary kind of stimulus we saw that came through. So lasting thought is it's a simple metric to watch, but I think it's one that'll it'll be very telling here in the days and weeks and months to come.
I 100% agree on that. And the last thing I'd say about bubbles, I'm going to anticipate a question that somebody who's been listening to us would say, there's lots of different types of bubbles. We're talking about market level bubble, whether there is one or isn't one. If you want to go down the stock level and look at a stock like Tesla or Hertz or Carnival Cruise and say, was there a little bit of bubble action in those stocks? Yeah, I think there was. But because Hertz goes bankrupt and winds up going from 75 cents to $6 and might be the first company ever to consider issuing equity while in bankruptcy as a sign that something's overheated, yeah, in Hertz, it doesn't necessarily mean that the whole market is that way. I tend to think it might be, but I'll agree that it is not as clear cut as it is in Hertz or in Tesla or something along those lines. Kristen, you want to finish it up and tell everybody a little bit more about us?
Absolutely. Well, first, just want to say thank you to both Jim and Ben for your time today and your thoughts. Greatly appreciate it. And thank you to everyone for joining us today. As a reminder, ArborResearch&Trading is an institutional research and brokerage firm that produces innovative research across a broad range of global fixed income, equity, currency, and commodity markets. Bianco Research and Arbor Data Science are our two most prominent research offerings. Arbor Data Science will be hosting a webinar tomorrow, Thursday, August 27th at 9 a.m. Central Standard Time. It's titled Inflation Knocking on Heaven's Door. Also, be on the lookout for an upcoming conference call with Jim Bianco next week. Details to follow. And for registration and further information on Arbor Research, Bianco Research, and Arbor Data Science, please contact Gus Handler, and his email address is gus.handler@arborresearch.com. Thank you, everyone.
Thank you.
Thank you.